Over the past 2 years, artificial intelligence has become one of the most widely discussed topics in the global economy. Company valuations have risen rapidly, governments have published strategic frameworks, and investment flows have reached record levels. Yet as of December 2025, a growing number of experts are asking the same question: have expectations surrounding AI moved ahead of its real economic capacity? This video seeks to address that question through a calm, evidence-based lens. The term AI bubble does not describe the technology itself, but rather the economic expectations placed upon it. Throughout 2024 and 2025, hundreds of AI startups reached billion-dollar valuations. However, many of them have struggled to establish sustainable revenue models. Analysts increasingly compare this period to earlier speculative phases in technology history. Investors speaking to Reuters have highlighted the operating costs of large language models as a key concern. Data centers, specialized chips, and rising energy demands are putting pressure on profit margins. Many companies are offering AI products at a loss in order to gain market share. While this approach can drive short-term growth, it raises questions about long-term financial resilience. By 2025, even the major technology companies shaping the sector have adopted a more cautious tone. Public statements increasingly emphasize efficiency and focus. These terms are often interpreted as signals that certain projects have been paused or scaled back. According to analysts, this may indicate that the market is entering a maturation phase. Mergers and acquisitions have also become a defining feature of this period. Financially weaker AI startups have been absorbed by larger players. This trend is widely seen as a move toward market concentration rather than open competition. Historically, such patterns have frequently emerged following periods of excessive valuation. Predictions about AI's impact on the labor market have also become more measured. The widespread job displacement scenarios discussed in 2023 have, by 2025, given way to more limited and sector-specific assessments. While AI automates certain tasks, human oversight remains essential in many fields. In sectors such as law, software development, and media, AI tools are now widely used. However, these systems primarily play a supporting role. Experts speaking to the BBC note that productivity gains have so far fallen short of early expectations. This has prompted a reassessment of the short-term promises attached to the technology. Energy consumption moved to the center of the AI debate in 2025. Running large-scale models requires significant electricity resources. In some countries, data centers are now being discussed within the context of national energy policy. Environmental costs are increasingly treated as a core component of financial analysis. Regulators have also taken a more active stance. New rules introduced in the European Union, the United States, and China address issues such as data security, copyright, and transparency. Analysts suggest these measures may slow rapid, unregulated growth, while potentially providing long-term stability for the sector. Financial markets have reflected this uncertainty. AI-related stocks experienced sharp volatility throughout 2025. Companies unable to demonstrate clear revenue generation faced heightened scrutiny. This shift suggests investors are focusing less on narratives and more on balance sheet fundamentals. Media coverage has evolved in parallel. Early optimistic headlines have been replaced by more cautious reporting. Issues such as hallucinations, misinformation risks, and legal liability are now discussed more openly. This change in tone reflects a broader maturation of public perception. Despite this, most experts do not view AI as a passing trend. Comparisons are frequently drawn to the post-dot-com era, when the internet endured despite widespread market corrections. Similarly, while inflated valuations may adjust, technologies with practical value are expected to remain. The hardware segment has shown relatively greater stability. High-performance chip manufacturers and infrastructure providers continue to generate steady revenue from AI investments. This suggests that the distribution of gains within the sector differs from early software-centric expectations. In areas such as education and healthcare, optimism remains, albeit more restrained. AI is delivering measurable benefits in decision support systems and data analysis. However, expectations of full automation have largely been scaled back, indicating a more realistic approach to adoption. Data availability has emerged as one of the most critical structural constraints on AI development. By 2025, access to high-quality, current and legally usable data has become increasingly limited. Researchers warn that training models on recycled or synthetic datasets may gradually degrade performance and reliability. This challenge suggests that AI growth may be constrained not by ambition, but by the finite nature of usable information itself. Geopolitical dynamics further complicate the outlook for artificial intelligence. Competition between the United States and China has taken on a strategic dimension that goes beyond market forces. State-backed funding and export controls increasingly shape development paths. Analysts caution that such intervention may distort valuations and increase the likelihood of a synchronized global market correction affecting both private and public AI initiatives. The restructuring of AI investments by several major corporations has drawn close attention from analysts and regulators alike. While companies often describe these decisions as strategic realignments, market observers interpret them as signals of broader deceleration. Reduced spending, delayed launches and narrower product focus indicate that earlier expansion plans are being reassessed under more demanding financial conditions. On the consumer side, enthusiasm for artificial intelligence features has become increasingly selective. Many digital platforms now include AI-based tools as standard offerings rather than differentiators. However, user engagement metrics suggest limited behavioral change. This pattern implies that novelty has faded and that consumer adoption will increasingly depend on clear, tangible benefits rather than technological branding alone. Economists increasingly characterize the current stage of AI development as a correction rather than a collapse. Periods of excessive optimism are giving way to more cautious expectations and disciplined investment strategies. Historical parallels indicate that such adjustments often strengthen surviving firms and technologies. The outcome is typically a leaner ecosystem, shaped more by performance than by speculation. The primary risk facing the AI sector lies less in technological failure than in misaligned expectations. If anticipated returns do not materialize within projected timeframes, confidence among investors and policymakers may erode. Such a shift could restrict funding for long-term research and infrastructure. Maintaining realistic projections is therefore seen as essential to sustaining innovation over time. For this reason, the language used by media outlets and policymakers has taken on renewed importance. Sensational claims are increasingly replaced by evidence-based assessments grounded in measurable outcomes. This more restrained narrative helps clarify both capabilities and limitations. By late 2025, this shift suggests a growing recognition that durable progress depends on credibility as much as technological advancement. Looking ahead, analysts expect the focus of AI development to move away from sheer model size toward practical deployment. Efficiency, reliability, and domain-specific performance are becoming the primary benchmarks of success. Investment decisions are increasingly tied to demonstrable value creation rather than theoretical potential, reflecting a broader recalibration of priorities across the sector. Within this evolving framework, artificial intelligence is no longer framed as either a transformational miracle or an impending disappointment. Instead, It is increasingly understood as a tool whose impact depends on context, governance, and implementation. Current debates emphasize integration over disruption, suggesting a gradual transition from experimental enthusiasm to institutional normalization. The central question, therefore, is not whether an AI bubble exists, but which structures will endure once market conditions stabilize. History shows that technological transitions often eliminate weaker participants while reinforcing foundational systems. Observers argue that the coming years will determine which business models, regulatory approaches, and technical architectures form the durable core of the AI economy. In this video, we examine the AI debate beyond headlines, focusing instead on structural trends and long-term implications. If you want to follow global developments through careful analysis rather than hype, Hidden Shift aims to provide that perspective. You can support this work by liking the video, sharing your views, and subscribing to the channel for future in-depth reporting.